All right, today we're diving deep into the upcoming Hong Kong IPO for QuantGroup. Now, this is a company with a really, and I mean really fascinating story that you absolutely need to understand before you even think about hitting that subscribe button.
So let's get right into it. On the one hand, you've got this incredible story of explosive growth. But on the other, there's a huge dependency hidden way down in its business model that honestly, it changes everything. We're going to unpack both sides of this coin.
But first, let's just get the basic facts down. The stock code is 02685HK, and they're pricing this thing between 8.8 and 9.8 Hong Kong dollars a share. Each lot is 500 shares, so you're looking at a company valued around 5 billion Hong Kong dollars. Now, a few key things to notice here. You've got strong sponsors in CICC and CITIC. But, and this is important, there are no cornerstone investors. Those are the big institutions that agree to buy a chunk of shares early and hold them, which usually adds some stability. We don't have that here. What we do have is a green shoe option, which basically lets the underwriter, CICC, sell more shares if demand is high to help keep the price stable right after it starts trading.
Okay, let's start with the bull case, the good stuff. Because when you first look at QuantGroup, its recent performance is pretty much exactly what growth investors are dreaming of when they look at an IPO. It's a fantastic story of a business pivot that just worked perfectly.
You see, the company completely shifted its focus to its e-commerce platform, Mei. And, well, the results have been kind of spectacular. Just look at these numbers from their own prospectus. Adjusted net profit just exploded from 130 million RMB back in 2022 to 360 million in 2024. I mean, that's the kind of hockey stick growth that really gets your attention.
And here's the kicker. It's not slowing down, it's actually speeding up. In just the first 5 months of this year, their adjusted profit shot up by an incredible 70.8% compared to the same period last year. This tells you their strategy isn't just working, it's hitting a whole new gear.
So let's just sum up the bull case, right? You've got a super successful pivot that's led to insane growth and soaring profits. And when you look at the valuation, around 11 times earnings, it actually seems pretty reasonable compared to other companies in the space. On paper, this thing looks like a home run. But, a story that looks this good almost always has a twist. So now let's flip the coin over and look at the bear case. Let's see how this growth is actually being fueled, because that's where we find the real, core risk of this whole investment.
This growth is real, there's no denying it. But when you see numbers like this, you have to ask a simple question. How are customers actually paying for all this stuff on the Xiaomi platform? Who is fronting the money for this explosion in sales?
Well, the answer, and really the entire bear case, comes down to one single company, Yingtan Guangda. This is a micro-lending company, and it's the financial engine that makes QuantGroup's e-commerce platform go by offering installment payment plans to all its users. Now, this is where it gets really interesting. Look at how this internal loop works. Step 1, a user buys something on an installment plan. Step 2, Yingtan Guangda pays QuantGroup for that product on behalf of the user. Now, step 3 is the critical part. QuantGroup gets to book the entire sale as revenue immediately. So a sale happens, revenue goes on the books, but the cash hasn't come from the customer. It's now just an IOU from this one lender, Yingtan Guangda.
And this slide right here, this shows you the staggering result of that loop. As of this past May, QuantGroup had a mountain of accounts receivable. And get this, 727.5 million RMB of it, that's pretty much the entire pile, was owed to them by just one single company, Yingtan Guangda.
Now, I know what you're thinking. Isn't that a related party transaction? Isn't that a huge red flag? Well, funny story. Just before filing for the IPO, the founder conveniently sold his stake in Yingtan Guangda. So on paper, legally, it's not a related party anymore. But that doesn't change the reality of the business one bit. It is still QuantGroup's single biggest debtor and the financial engine for its entire platform. So what we have here is this incredible tension. On one side, you have a fantastic growth story. On the other, you have this fragile business model that has a single point of failure. So as an investor, how do you break the tie? Well, for a Hong Kong IPO, you have to look beyond the business and at the structure of the deal itself. It really boils down to this dilemma, doesn't it? A high-growth, profitable company versus one with a massive, concentrated risk to a single counterparty. It's a perfect tug-of-war. So, which story wins out?
The answer might just come down to this number, 2,700. That is the incredibly small number of lots that are actually being offered to the public for subscription in Hong Kong. And let me tell you, that is tiny, exceptionally tiny.
So why does that tiny number matter so much? Well, it sets up some really powerful market mechanics. First, an extremely small public float can create a classic supply and demand squeeze right when trading starts. There just aren't many shares to go around. Second, remember, there are no cornerstone investors locking up big chunks of stock, which makes that available supply even tighter. And finally, you have a very strong stabilization agent, CICIC, ready to jump in and support the price. All of this suggests that how the stock trades at first might have more to do with these market forces than with the long-term fundamentals we've been talking about.
Okay, so let's put all the pieces together. We've got the impressive growth, we've got the profound underlying risk, and we've got this very unique market setup for the deal itself. Let's use all that to come up with a final subscription strategy.
So here's the most crucial point to understand. For an IPO with a float this small, the short-term market dynamics, the simple math of supply and demand, can often completely overpower the long-term debate about the business risks, at least in the beginning.
So here's the final verdict. The massive risks tied to Yingtan Guangda are very real, and you should absolutely not ignore them if you're thinking about holding the stock for the long term. However, the combination of a genuinely strong growth story and these highly favorable market mechanics makes this IPO, in my opinion, an attractive subscription for its short-term potential.
And that really is the final thought I want to leave you with. The math for subscribing to this IPO looks compelling, but every single investor has to ask themselves, are you truly comfortable owning a piece of a company with such a deep-seated and unique risk for the long haul? That's the billion-dollar question you're going to have to answer for yourself after the debut. Thanks for tuning in.